Good morning, everybody. Welcome to this Scope Ratings Credit Outlook call on the events in Russia and Ukraine and their impact on our credit environment here in Europe. Before we start, let me all remind you that this is a research call, so anything said and discussed today on this call should not be seen in connection with any rating action that may or may not be forthcoming in respect to any of the subjects that we are raising here today in this discussion. With that out of the way, may I introduce myself? I'm Dierk Brandenburg. I'm Scope's Head of Research and ESG. And with me today, I have our analytical team heads from the corporate team, that is Olaf Telke. I have Marco Troiano from the financials team. I have Dennis Shen from the sovereign team. And I have Levin Kamarian, who's our lead analyst on Russia. Before we move into the different sector discussions, I thought it would be worth just sort of setting the overall scene for the environment we're actually operating in at the moment, both in terms of issuers and investors. And I think one important thing to highlight here is that before Ukraine came on the radar screen, quite surprisingly, at the end of February, we already were dealing with quite a difficult credit environment. The credit markets had a very interesting or volatile start to the year, mainly because yields started rising, because investors were asking themselves the question, well, at what levels should we be holding government bonds, given what's going on with inflation and with central banks? And at the same time, credit investors were asking themselves the questions, well, if the outlook is potentially deteriorating here, the economic outlook, then what spreads should we be asking to hold these securities going forward? Or on the other side, what will issuers have to pay to access markets? And I think that was particularly pronounced in the high yield markets, who had a particularly bad start to the year. And I think what essentially the Ukraine crisis did, both in our own thinking as well as in the way of the market, is sort of re-emphasized and accelerated some of the trends that were already on the table from the beginning of January. One theme here is clearly the very high inflation rates that we're seeing in major economies. In the US, we have to go back 40 years to see similar CPI prints, and then in the euro area, we're actually technically seeing the highest that was recorded, or clearly the history is not as long here, and pre-euro, there were some pretty high inflation rates as well in euro member states. But that has clearly unrattled investors here and issuers, and also bears the question what the reaction function is of central banks going forward. In a way, the only thing the Russian-Ukraine, well, first of all, the war, but then also the sanction, most importantly, is they sort of emphasize the volatility in both on all these aspects, in the sense that the implosion of Russian asset prices, increased risk aversion, pushed credit spreads wider, and then on the other side, we had this enormous increase in energy prices and indeed other commodity prices as well, that sort of fuels this already dire inflation scenario, and we're ending up in a much longer and higher inflation regime than we would have thought at this stage. On the good news, markets did interpret these results quite interestingly, in the sense that there was a flight to quality, so that widens credit spreads, but it also lowered expectations for yields a bit, and also I guess led to a slight reevaluation of how central banks may actually react in this environment, particularly because why in the short term a lot of these trends are fueling inflation, there's also the long-term potentially deflationary impact to the extent that it reduces disposable incomes and demand. To that extent, there was some relief here. And I think for credit investors and generally issuers, I think it's important to once in a while look at real yields in this context, because clearly real yields have been negative for many years, particularly in Europe, also in the US recently. And fundamentally, as bad as that may be for the economic outlook in the eyes of some investors, and also obviously the returns that are achievable here, it is a positive that still underpins highly indebted borrowers, both on the sovereign, on the household, and also on the corporate side, because the overall burden, the real burden relative to the inflation rates that are out there is negative, i.e. benefiting essentially borrowers in this environment. So the main point here is it is not all bad for credit, but it is clearly quite a change that we've seen in the last 2 months. With that, I want to just add one other point. The economic outlook going into this crisis was actually still very positive. So we had a lot of momentum in economies in Europe, in the US, only exception really being China here. And also the recent economic data was quite strong. So when we discuss the negative impacts or the risks associated with some of the events today on the call, we shouldn't forget that we're going into this with quite a significant real economic momentum, which also allows some buffers here in terms of the ultimate impact this will have. And that is quite a difference to previous episodes of crisis, which there have been plenty over the last 10 or 15 years, because we always discuss them in a very much in a deflationary environment, where even the slightest disruptions to growth already had quite a negative effect, both on inflation and then economic growth. So in this situation, which is kind of new post-COVID world, we not only have high inflation, but we also have reasonable economic momentum, particularly in Europe. With that, I hand it over to my colleagues from the corporate team, to Olaf Tölke, who will take us through our thinking, what this economic environment and the Ukraine-Russia crisis means for our corporate credit outlook. Olaf, you want to take over?
Yes, thank you, Dirk. Good morning, everybody. I'm Olaf Tölke from the Corporates division. So while corporates are certainly not the main segment to be hit immediately compared to sovereigns, where you see immediate downgrades, and maybe banking as well. So far, we have had very limited effect in corporates. That's certainly reflecting the status quo, as the picture is unfolding. Developments are unfolding. Clearly, we have very limited transparency. Nobody knows whether there will be an escalation or how long the crisis will last in the end. And so far, we have only looked at the direct effects for the corporates. Also, to say we have not covered, or we do not cover any companies directly in Russia and Ukraine so far. But on the direct effects, of course, we have looked at business exposure. So how important is the end market to the Western companies we cover in Russia and Ukraine? And we have also looked at funding implications. You might know we cover quite a number of Hungarian companies, also some companies in Georgia. So we looked at the funding to the extent somebody is very much dependent on Russian banks, which have been affected by embargoes. On the Western side, when you look at sort of iBox companies, there's limited direct exposure. I think BASF has probably said they have 1% of the whole business done in Russia, mostly. Limited production exposure. The country is not that important. So from that point of view, from a direct immediate impact, no immediate action course for corporates on a credit point of view. Of course, as always, and we've seen this in the COVID crisis as well, the corporate sector is very diverse. You have sectors who are immediately hit. You have sectors which can benefit as well. So due to the very high price impacts we have seen in energy, but also in food immediately, some of the energy companies might even benefit when I look at oil and gas production. And we have seen significantly rising prices, as Dirk also alluded to already in the course of the last 2 years, due to COVID, supply chain disruptions, and you have it. So secondary effects certainly will need to be checked. We need to watch the space, of course, as always, because on the rising raw material input prices, it will then depend, credit quality will depend on the company's ability to pass on on the input prices in their own selling prices. And there we have to see the individual situation. I mean, a sector like airlines, for example, which has already been hardly hit in the last crisis, will all be affected by the same extent by rising fuel prices. So then the immediate conclusion would be that there would be some pricing flexibility on their selling prices as well. And then the question is, how much will higher ticket prices affect demand in the end? So that's the challenge we have to do, watch the crisis significantly. On a more positive note, certainly when you look at 2021 numbers, they have been rather strong because we've seen quite a big recovery from 2020 in the reports which are coming through right now, also on the quarterly trends. So companies are relatively in a very good position to weather some storm in the short term. As I said, there's very limited transparency on how long this crisis will be. So far, credit quality in corporates have not been affected significantly, but watch that space. Certainly everything which is energy intensive on the production side, like steel, or also some part of construction, like concrete production, fertilizers, are immediately hit. That's an easy conclusion. Again, on the pricing side, on the selling side, we have to watch the situation individually. And that's it from my side. So far, we didn't have any rating actions on the corporate side. But that's not to say that this is the end situation. It might well be the case, depending on the further development of the crisis. That's it so far in a snapshot from my side. Back to you, Dierk.
Yeah, thank you, Olaf. Just to remind everybody, you can ask questions through the chat, and I will obviously relay them. And they're anonymous, so there's no need to be afraid. And I will also relay them here to the speakers. Olaf, coming back on your remarks here, and also on the sort of corporate credit matrix that we operate here, we can see you quite confident about utilities and oil and gas actually having positive operating trends as part of this the repricing here in commodities markets. We can also see you expect CapEx to go up a lot in these areas. So is that to say that those sectors would basically pass through all the costs here pretty quickly? And I'm thinking particularly about utilities, and also they would then on top of that also increase demand, i.e. potentially fuel more inflation just by the enormous capex needs here, from particularly I guess from Europe diversifying away from Russian energy. Is that a fair statement about this sector?
Yeah, that's about right. I mean, clearly the operating trends have been affected above all by higher prices, as you said. On the capex side, clearly, if you have good cash flow, you can afford to spend more on capex. We've seen that trend on utilities already before, so certainly there's much higher infrastructure requirements on the networks for these companies. But it needs to be seen whether this trend will prevail. I mean, if we really get a global sort of military action, I don't think capex will continue to rise. And certainly that needs to be seen in dependence on the further development of the crisis. But so far we've seen rising capex trends in utilities, and certainly also on the energy side.
And where, I mean, what is your underlying, I guess, assumption or your view in terms of the oil price? Is this sustainable at these levels? So can the industry actually deal with much higher prices here if necessary? I mean, what is it, what you factor into your analysis at the moment?
Yeah, I mean, we are still very benign. I think our average oil price being built into our base cases is below 80, which is very, very low. So we have a lot of upside, certainly on the gas side, and on the oil, you've seen significant rising prices. So far, our base case, which we look at for our credit scenario for 2022 and 23, is reflecting moderate oil price levels compared to the actual level. Certainly, is it sustainable? I mean, nobody knows. that's really dependent on the geopolitical side. So I hope it's not sustainable, but definitely, who knows? It's not an analytical decision. It's more like a political, military effect, which drives these prices steeply up right now. And that's good for the production, but definitely very bad news for the users of the energy.
And an outright import stop by the EU, if that were ever to come on your agenda, I mean, stress that this is a totally hypothetical scenario, and this is just relaying an audience question here. But how would you think? I mean, do utilities? I mean, I know oil and gas obviously have global operations, but particular utilities in Europe, how would they react to that?
Yeah, I mean, Germany overall, I think, is very much dependent on Russian energy, especially oil, but also gas. So here, if there would be an import stop, I think there might be a huge problem. Certainly, we have companies in Norway who are gas producers who could certainly, Equinor, who could certainly fill in a little bit, but I don't think anybody could fully replace the Russian oil. So if that would come, it would definitely create major problems, probably for the whole industry. Yeah, definitely.
Okay, and if you talk about capex in utilities, oil and gas, is that also, and this is again relaying some questions here, there's actually quite a bit on that, in terms of renewables investment, do you think that has been sort of like a game changer or accelerator here of those types of capex into renewables?
Yeah, I mean, the writing was on the wall. We have the energy transformation back from fossil and nuclear to renewables, also favored or fostered by the political situation in Germany. The Greens are in the government. But this crisis has really accelerated things, and I think it dawns now on many people that going out of fossil and nuclear at the same time for the largest economy in Europe might not have been a very good idea. So definitely, fossil is on the and renewables is on the rise, but it cannot quickly ramp up enough to replace the other two energy sites or sources.
Okay, thank you. I mean, I put one more question through here because there's quite an interest in the column on the right here on the political and regulatory backdrop. I suspect utilities and oil and gas, they're quite exposed to, I guess, price controls and windfall taxes, but you also have a positive view on the auto industry. Is that also related to sort of renewables and activities here, or how do they differentiate those?
Yeah, I mean, operating trends, we have changed it. It was positive before because I think the realization was that especially the German auto side, didn't do as badly as especially equity investors expected. So we have moved this back. I mean, certainly this is also generated a little bit by the electrification trends and the change in the combustion from combustion to battery driven or sort of what's the word? Hypercars, I don't know, between can't think of this, but certainly from a crisis point of view, immediately we see more like a parallel thing in political regulatory backdrop. Of course, all the politicians are favoring sort of clean energy cars, and that's what the main manufacturers have done quite nicely. I mean, the jury is still out on the battery side, on the reach of the battery, which to me still looks very limited, and the lack of the infrastructure with the sort of stations where you can recharge the car, but from political side, there's massive tax incentives to go into battery and hybrid. That's what I was looking for. Technologies, and the German and the other European car manufacturers have taken advantage. Those innovation here, it looks like the pricing is very favorable. We understand that the margins in future can actually be higher than anything which has been done in the past. So there's a significant upside here if the industry gets it right to actually improve their margins going forward. Now, from a Russian crisis, definitely, if you only look at the target markets from demand side, it's not gonna be a major impact for the European car industry. Maybe with the exception of Renault. Renault is quite strong in Russia. but for the major ones, definitely not. Certainly, if we have an escalation of the crisis, it will affect pretty much every sector. That's for sure.
Okay, thank you. That just underlines how diverse really the impact is here on the corporate sector, and there are pluses and negatives. Certainly, big opportunity here for diverging also credit path here going forward. I have some other questions here on energy security. I think we will revisit them later because we have also a sort of a macro view on that. So with that, I would then move over to Marco Troiano, who heads up our financial institutions analytical franchise. And Marco, banks found themselves once again in the middle of the storm. Can you just talk us through what your views are on that?
Yeah, sure. I mean, banks are banks, still perceived as a high beta sector. So that's what investors do. Uncertainty. So you sell the banks first, ask questions later. I mean, from our perspective, we've obviously faced a lot of uncertainty. We've started screening our portfolio of rated banks, which mostly comprise Western European large banks. We also have some exposure to the region. And we've tried to identify the channels of potential impact. I would say, I mean, the overall message is that the direct impacts are very manageable in our view, and that the big question mark relates to the implications of this crisis for the macro outlook, which our colleagues are going to speak about in a few minutes. In particular, I think just looking at taking the eagle-eye view on these exposures to Russia. I mean, Ukraine is a very small market. I mean, this is unlikely to be material for any of the banks we rate. Russia is obviously a bigger market, but exposures have really gone down after the annexation of Crimea. They've, I think, halved from, if you look at the combined, Russia plus Ukraine plus Belarus, they've halved from $300 billion to around $150 billion, that including public and private sector. So it's a market which is big, but not as interconnected to the West as it used to be. Now, obviously, there are some banks which operate local subsidiaries in Russia and in Ukraine, for that matter. There have been a lot of big numbers going around with respect to SocGen, UniCredit, RBI having subsidiaries with around 20 billion in assets. The reality is when you look at the potential credit risk at group level, the calculations are a little bit more complex. You need to assume that in the worst case scenario, the banks walk away from their subsidiaries, so they lose the equity investment, but they also get to deconsolidate the risk-weighted assets associated with the subsidiaries. So from that perspective, impact on capital ratios on solvency is going to be very limited, typically under 100 bips. The more relevant aspect here is that these subsidiaries, at least for some of the banks, represent a very material portion of total profits at group level. So there is a matter of earnings dependency, as you can see on this chart, for example, for RBI or OTP, much less so for SocGen or UniCredit if you take earnings on a normalized basis. And that's really, what can impact the credit profile of these banks. Now, is it a given that the banks will walk away from their subsidiaries in Russia? It's not clear yet. I think there are still a range of strategic options for the banks. I think our base case has been moving towards the walkaway option, but until they're forced to do so, they'll probably try and stay there, take a wait-and-see approach. In the unlikely event that there is a rapid de-escalation of the conflict and of the sanctions, we might see them keep their assets there. Obviously, they're going to be worth a lot less than they are today. First of all, ruble depreciation will dilute the contribution of earnings on their parent company group profits. Secondly, the local asset quality is going to probably turn into a complete disaster there as the economy suffers. And when we've highlighted actually in a commentary yesterday from our colleagues from Scope Insight, Sam Theodore, that there is now significant reputational risk also attached to staying in Russia. We've seen several Western companies pull out of the country, including I think McDonald's yesterday. And I think in the brave new world of ESG awareness, seeing as being associated with the Russian regime carries increasing risks, not only from a legal standpoint, and we'll touch upon that in a second, but also really on the reputational side in terms of brand value and investors' willingness to do business. There is also a third scenario which we see as increasingly unlikely, and that is that banks actually decide to put more money into their local subsidiaries in Russia and Ukraine, perhaps to stabilize the local funding position there. We know that the situation is very difficult on the ground. There are reports of an ongoing bank run on Russian banks and outflows of deposits from Russian banks. But I think at this point, management teams would be very wary of potentially throwing good money after bad. And I also think that there could be issues with getting supervisory approvals to downstream capital into local subsidiaries if this was for significant amounts. So all in all, impact on European banks from their subsidiaries in Russia and Ukraine is very manageable. We also have other channels of impact, of course, outside of local exposures. We have offshore exposures. A number of banks have published press releases detailing their exposures. We have some data from the BIS, from the EBA transparency exercise, from Pillar 3 reports. We've tried to proxy the exposure for banks that have reported being in that line of business in the past. These are slightly more material. The reason is that they're not locally funded, but they're funded through parent companies. So they could lead to higher losses. But again, when we look at it in terms of capital impacts, yes, worst case scenario, complete write-off could lead to losses for some banks of up to 200 basis points. But we also see this as manageable in the context of banks' capital excess and profitability going into this crisis. I think this is a very important point to make. I mean, the European banking sector is entering this new crisis from a very strong starting point. The sector is incredibly de-risked after the global financial crisis of 2008, and actually the COVID crisis has sort of been an acid test for this de-risking of the sector. It's a lot more, it's a lot better supervised. It's more capitalized. It's got more liquidity, and banks have gotten out of the riskier areas of their business models. So I think there is enough buffer there to withstand this impact. The biggest question mark, as I mentioned before, is on the actual economic outlook. Equity markets and equity investors particularly got very excited at the beginning of the year about the prospect of rising rates. As you know, banks are maturity transformation machines. They make money from borrowing short-term and lending long-term. So with flat yield curve and interest rate at sub-zero level, it's a very difficult world for them. This has been the case for the past 10 years. So for the first time after 10 years, we were looking at a slightly better outlook for revenues. That's now again called into questions, and we'll see what the reaction functions of the central banks will be to this crisis starting this afternoon with the ECB. But there is a definitely downside to this top line scenario. There is also obviously downside risk to asset quality, both on local assets in Russia and Ukraine, but also more generally to exposures in Eastern Europe, which have very clear trade links with Russia. More generally to companies, as Olaf mentioned a few minutes ago, that are highly dependent on energy input, and where there might be more uncertain whether they have the ability to pass through price increases. We also think the high inflation starting from this year might start pressuring wages in the banking sector. Wage inflation has been very controlled for a very long time in Europe. whether this is still going to be the case, I think it's very questionable going ahead. And then finally, we see this from increased cost of wholesale funding, in particular with respect to MREL eligible debt, which banks will need to issue to comply with MREL. There are obviously, I think, also other more difficult to forecast type of implications for European banks, starting with the financial volatility that we are seeing in the past couple of weeks. This obviously has the potential to impact trading income in Q1 for banks which are exposed to markets, and in particular to derivatives markets and commodity trading. Obviously, that's a big question mark. And the other big question mark is around asset management and investment banking revenues. More generally, volatility is not good for pipelines. We know that banks exposed to capital market might see a weaker quarter than originally expected. So we're seeing downgrades across the board to bank revenues in investment banking. And then I would flag two other typologies of risk that I think are a little bit under the radar still. One is the risk that banks fail to comply with the sanctions regime. This has been put in place very rapidly, news flow changing every day. So the degree of adaptation of the different banks might be different, and we'll only find out about this after the fact. It's very difficult to anticipate this type of risk, but at a minimum, you can expect some negative pressure on business volumes due to this. Banks will have to at least accept loss of volume with some of the sanctioned companies and individuals. In the worst case scenario, they fail to actually identify these sanctioned individuals, and then they're subject to fines maybe a few years down the road. Not to mention, again, reputational risk, which we think might be very relevant in this environment. And the second risk, which is a lot more difficult to anticipate, is obviously cyber risk. We know that that's part of non-conventional weapons deployed these days by the superpowers. And we look at banks as critical infrastructure in global capitalism. So you have to expect at least attempts to hit them. Again, very difficult to anticipate. We'll find out after the fact, and very difficult to differentiate banks, but something to keep an eye on.
Thank you, Marco. In the interest of time, I would like to move on to the sovereign aspects. Just so in terms of the questions that were asked here, we had one question on Austrian exposures and the insurance sector. So here I have to add that we do not cover Austrian insurance companies, so we're not the right people to ask here. And I think we have answered the question in terms of RBI being sort of the key entity here being exposed, not only in Austria, but also at the European level. And then we had another question on impact on NPLs and provisions, but I think we also indicated here that there's going to be some impact, in particular in terms of both the cross-border exposures and the direct investment banks have. But at this point, we consider that to be manageable, both in terms of the capital that the banks have and then also the earnings buffers that are available.
If I can add on this one, Dierk, I mean, it's really, we're looking at such a broad range of scenarios that I think putting out a final estimate here is very difficult. We're going from a hot nuclear war to energy rationing to complete de-escalation of the conflict. So I think in the milder scenarios, impact on Western Europe can be very minimal. If you get to an energy rationing situation, obviously even banks that have nothing to do with Eastern Europe, and I'm thinking perhaps banks with exposure to domestic UK or domestic Spain, might see an impact through their asset quality and then P&L, simply because of the second round effect on growth spillovers. So that's my caveat, big one.
Yeah, no, that's very wise to hedge your bets in this environment. I think everybody in the audience appreciates that. But talking about second round effects and talking about what lies ahead. So this is now moving on the discussion to the sovereign and public finance aspects of the crisis. And with that, I'll hand it over to Dennis Shen from our public finance group.
Many thanks, Dirk, and a good morning, I think, still. So I'm represented in the team with Levon Kamarian. We'll begin just by touching on some of the aspects in terms of two specific credits, which I would imagine are on the top of many people's minds, those being Ukraine and that of the Russian Federation. With Ukraine, we were the only credit rating agency to have had Ukraine on negative outlook before the conflict. That has nothing to do with anything Ukraine did, but rather in terms of taking seriously the likelihood for escalation of the ongoing tensions with Russia, which have been ongoing for the period since 2014. Since then, we have taken the rating of Ukraine from the single B level to triple C, with those ratings currently under review for potential change. Clearly, this year there's every expectation that Ukraine will be in deep economic recession, regrettably, due to the circumstances. And in addition, that there will be impairment in terms of the debt sustainability. Again, which is unfortunate because Ukraine had been making rather significant progress in terms of reducing debt under the initial recovery from the COVID-19 crisis. There's been, I suppose, a period at the stage of more restricted international market access. However, Ukraine maintains domestic capital market access in vis-a-vis issuance in hryvnia. And as if not more importantly, due to the significant international and I think rightful sympathy for the circumstance in Ukraine, there has been a significant international financial support, really from all corners of the globe, from multilateral, bilateral sources. Also relevant to the credit outlook, especially under scenarios of so-called regime change. Naturally, one aspect that we have in the back of as being relevant to the outlook also might relate to heightened civil and political instability.
So we downgraded Russia's sovereign ratings to CCC last week and placed them under review for possible further downgrade. The main driver of our downgrade was the imposition of capital controls by Russian authorities in response to international sanctions, which in our view signal less willingness of Russia to service its debt to foreign investors, regardless of issuing currency in rubles or in hard currency. Importantly, Russia prohibited residents from servicing new foreign currency denominated lending arrangements and from transferring payments on local currency bonds to foreign investors. We think that such policy measures materially increase the risk of a default event in the short term. The second major driver of our downgrade was the unprecedented economic and financial sanctions by the United States, the European Union, UK, and other international partners. And the severity of these sanctions represents a substantial deviation from our baseline and is of course undermining Russia's ability to ensure a timely debt service, making Russia more vulnerable to banking crisis, to liquidity crisis. And finally, there is the medium-term impact beyond what's happening currently. And here we think that the economic, financial, and political effects of the current crisis will significantly weaken Russia's medium-run macro financial stability and also undermine institutional credibility, leading to both acute and prolonged loss of investor confidence, as recently exemplified by the removal of Russian securities from major stock market indices. Currently, SCOP is using the review period to further assess Russia's willingness to service its debt in full and on time within the stipulated grace periods and within the contractual terms.
Clearly, there are many scenarios currently, as also referenced by Olaf and Marco before. And they run from as the talks are currently ongoing and unsuccessful to date, but nonetheless with the objective for accelerating such talks. And given that the military operation from the Russian end has not technically been going that well, the scenario for there to be ceasefire with agreement, especially with relevance to the term neutrality, having to be potentially on the table as far as Ukraine's NATO, and in addition EU potentially accession objectives. Secondly, one in which a pro-Russian government were to be installed in Ukraine by force. And under such a scenario, potentially a Western recognized government, whether based in Western Ukraine or in exile, and a pro-Russian government in Kiev. Any such scenario would effectively ensure a prolonged period of domestic instability because Ukrainians are not going to accept this. Alternatively, one in which the Zelensky government, the Volodymyr Zelensky government, remains in place, continues to defend the nation's territorial integrity with courage, and in that respect, a drawn-out conflict with Russia. And finally, depending upon the so-called success in this special operation in the Ukraine from the Russian government, especially if it were to be considered to be successful, then the possibility for further incursion in other nations in the geographical neighborhood, especially with relevance to former Soviet republics, we name Moldova, Georgia, in that respect. Importantly, the outlook entering into 2022 from a macro standpoint was one in which with expectation for robust but uneven economic recovery, and signaling that the risk to that economic outlook for this year was one skewed onto the downside. One of the core risks, as highlighted in December, in terms of the reason underlying a downside skew to the economic outlook, related to risks in emerging markets, and specifically the possibility for Russian escalation of the conflict in Ukraine based upon the US intelligence assessments at the time. At this stage, I think it's only fair to state that downside revisions of the economic outlook, certainly with respect to 2022, are inevitable. And the severity and scale of those revisions being contingent upon the evolution of the conflict and consequences in terms of the sanctions and countermeasures. One graphic we include on the right relates to that from Oxford Economics, and at least in terms of the Euro area, well, probably at the minimum in terms of at an economic impact of 0.5 percentage points, according to this graphic, for 2022. And really the question being, how much into that orange bar in terms of the downside scenario we are at the stage, depending on the duration of the conflict. And from a quarterly standpoint, in the euro area, the question of technical recession, 2 consecutive quarters of economic contraction is on the table. But naturally, we are technically only 2 weeks into this conflict, so much there's still significant uncertainty in that respect. There have been sanctions and countermeasures beyond expectations, and at this stage, the types of measures that have truly been punishing to the economic conditions in Russia. Importantly, inflation. That inflation was already fairly meaningfully above targets, above expectations and the like prior to the conflict escalating. At this stage, it's I think that could be expected that inflation over the near term would only rise further from already rather elevated rates on the basis of evolution in commodity prices and energy prices and the like, as well as further supply chain bottlenecks with the degree of stress undergoing the Russian and Ukrainian economies. And that even after inflation eventually peaks and begins to recede, that consistent with the view that we've taken, that inflation, in terms of the rate that inflation might recede to over the long run, it's likely to be a higher equilibrium rate after this crisis compared to the reference point before the COVID-19 crisis. The conflict from a financial market standpoint is not only about Russia, Ukraine. It's not only about sectors that might be directly impaired by the crisis, but rather also from a sovereign standpoint, there has been spillover to a degree, including to the geographical neighbors with borders along Russia and Ukraine. Higher bond yields in some of those specific nation states in Central and Eastern Europe, as well as a degree of sell-off in the exchange rates in the right-hand graphic, including with especially relevance to the Polish zloty. There are, in addition to financial market correlations and co-integrations, there are economic consequences. And there are, of course, many economies with significant trade and exporting of products and services to Russia and Ukraine. That's in the left-hand graphic, including many of those in Central and Eastern Europe. And finally, there are implications in terms of sovereign credit ratings. Naturally, in terms of ratings, aside from Russia and Ukraine, a significant amount of in the end, the degree of adverse risk depends upon the durability and the severity of the crisis. At the same time, there are, at least in the near term, some offsetting measures that relates to the expectation that central bank policy, that monetary policy, will, as a result of the crisis, be more accommodative, and in terms of the degree of gradualization in the intentions for normalizing monetary policy after the COVID-19 crisis. And in addition, that fiscal policy is likely to be similarly more accommodative. That goes beyond increased defense spending or increased fiscal support for the Ukraine, in addition to counter-cyclical spending, to offset to a degree some of the economic attrition and spillover from this crisis. At the same time, that might be true from the economic standpoint, but in terms of the ratings, with monetary policy remaining potentially more accommodative now, at least for the immediate future, naturally that also has an effect on longer run inflation expectations and raises the likelihood for a sharper correction and the like in financial conditions. In addition, with the fiscal support being provided probably as a result of this crisis, after the significant use of the sovereign balance sheet during COVID-19, that also has additional costs as far as debt sustainability. Finally, in terms of comparing between nation states, as Dierk referenced, that comparing emerging markets within crisis scenarios such as this, it goes beyond only Central and Eastern Europe, that there is a flight to safety, which affects emerging markets more globally, and vice versa in terms of attracting inflows to safe haven nation states in advanced economies. I'll stop there.
Thank you, Dennis. Just come straight back with some audience questions here. So there's actually one really good question. Somebody asking, well, how is this possible? You know, Russia, I mean, it was investment grade before going into this. It has a lot of natural resources. All the prices have gone up for these resources. I mean, how is it possible that people are so convinced that they will basically default on all their obligations? And I think Levin and both Dennis, I mean, you outlined the sanctions and all these measures are in place, but why is everybody so convinced, or what are the technical obstacles here that make you so convinced that there's no way they can, well, there's never no way, but this is so unlikely that they won't honor their obligation or won't be able or willing to honor their obligations?
Sure. So the question goes more about into the ability of sovereign, and as we all know, sovereign defaults could be the result of both inability of sovereign to pay back its debt, its commercial debt in full and on time, but also unwillingness of a sovereign to honor its debt obligations in full and on time. And our view is that the recent policy measures of Russian authorities, including the major capital controls, are signaling less willingness of Russian state to service its commercial debt obligations to foreign residents in full and on time.
I mean, we have a chart here actually about the likelihood of coupon defaults here. So I think this is, I guess, the one issue here that just technically it's hard to see how they can either be able or willing to particularly meet these cash flows in the coming days. So I think that is sort of the most immediate cash flows or basically default events that are lying ahead here. I had another question, and I think you alluded to this in your scenarios, Dennis, which is really what are you factoring in here? So basically there are the events in Ukraine, and you do reference actually the escalation here as well to other nations. Question really is, what likelihood do you put, or how important is this for your scenarios going forward, your economic scenarios, if that were to happen, if that conflict escalates? I mean, they have attacked Georgia before. Moldova is already half, or not half, but to a certain extent under Russian occupation. And there are, potentially other expansions here. How important is that for you?
I mean, it's very important. I mean, there are multiple manners in which there could be escalation. That could be within the military operations in Ukraine, and naturally, if they deem that there's the political support and/or that there's the appetite for it, then the threat to neighboring nations. And as noted, that I presume that especially for nation states of the former Soviet Union that are not under the protection of NATO or under the protection of the joint defense clauses of the European Union, those specific nation states have a right to feel intimidated. And there is a reason that now that two nations specifically, being Moldova and Georgia, have accelerated their EU accession plans with a formal application. So it's not only Ukraine in that respect. And so depending on the duration and severity of the crisis, naturally if the crisis itself, if in terms of the objectives of the Kremlin as far as rebuilding the former Soviet Union and if that were to be extended, whether in terms of the objectives in Ukraine, as noted in terms of coercing potential government change, further incursion into territorial integrity, any change in government policies relating to NATO and the EU. If those ambitions as well, depending on how well this goes, again, it's not going that well at the moment. If it were to continue into other nation states, then naturally that degree of escalation, in part also ensures the duration of the crisis will be lengthier. And in addition, in terms of the sanctions, counter sanctions, and the like from Western nation states, I think that would raise significant alarm were this to extend past the boundaries of Ukraine. And naturally, in terms of the economic costs and all that associated, would only make that more meaningful.
Thank you. We have 5 minutes left. I had one question on Belarus. I'm just going to answer that by saying that we do not rate that country. And so given the short time we have left, I would prefer actually to move the discussion back to some questions we had at the beginning. And I think it's building on what Olaf pointed out on rising capex. And we also have rising government expenditure, German defense, various European funds that are being discussed. So the question to you, Dennis, maybe hopefully on a positive note here, the fiscal situation, can we expect some meaningful, or would that make a big difference to your outlook if we get some meaningful fiscal expansion on the back of this? How do you judge that?
I mean, it's from a credit standpoint, it's in part a double-edged sword. So to the extent that there's a meaningful economic slowdown, then we know under Keynesian economics that the fiscal multiplier increases, and extending beyond defense spending to expenditures in terms of then being able to support companies, businesses, many of which are still struggling to be able to recover and to raise profitability and the like after the COVID-19 crisis, which we're still going through at the moment. That from that standpoint, in terms of being able to provide a cushion beneath the economy, depending on the severity of the slowdown, because again, the term to the further invasion has been 2 weeks at this stage. Then actually that provides a degree of support if it prevents a more severe vicious cycle in economies and the like. At the same time, naturally, as we know, that the impairment in sovereign balance sheets, in part related to whether contingent liabilities or direct spending during crises, that even if there might be central bank support within the near term in terms of making possible that fiscal spending, that as central bank policies normalize over the course of the medium to longer term, and with sovereign balance sheets, including spending during crises or downturn scenarios, having resulted in some degree of additional costs, that does as well challenge to an extent that sustainability. So there are both angles in that respect.
Okay, great. Thank you. As always, from economists, you get two-handed answers. So I think that's just owed to the situation here, and I think it's also, I guess, the reason why our views will evolve in this area. But for today, we're up to the hour, so I need to close this call, and I appreciate the audience staying with us until this point. We have the slides available for download on this web facility, and we also published a supporting Outlook piece this morning on our website. So, as always, we're also available taking your questions directly via email if that is necessary. With that, thank you very much to my presenters this morning, and I wish everybody a good day. Thank you. Bye-bye.
Thank you.
Thank you.